Welcome. Today we are setting out on a comprehensive examination of Bitcoin, which is, well, arguably one of the most transformative inventions of the 21st century.
It really is.
We're going to be tracing its entire origin and its evolution, drawing on this really detailed stack of source materials we have, a historical timeline that chronicles this incredible journey from a simple white paper to really a global financial force.
The evolution of Bitcoin is such a fascinating case study, and it's because the fundamental nature of the asset, according to these sources, has just shifted so dramatically over time.
Okay, so where do we start? What's the core definition?
Well, we start with the basics. Bitcoin is a cryptocurrency. It's a digital asset that uses cryptography for control and management. And crucially, it was designed to operate without any reliance on, central authorities.
No banks, no governments.
Exactly. But here's the key shift. While it was explicitly launched as a medium of exchange, the paper called it a peer-to-peer electronic cash system today, it's primarily come to be regarded as a store of value, something more like digital gold.
And that shift from medium of exchange to store of value, that really defines the entire 15-plus-year saga we're about to unpack.
Yeah.
Our mission today is to move beyond just listing dates and names. We need to identify and analyze the critical technological challenges, the political pressures, and the regulatory inflection points that force this transformation.
Right.
Why did these specific moments, from a bug fix in 2010 to a ruling in a U.S. court, why did they fundamentally reshape the world's understanding of digital currency? So let's start the clock. Not in 2009, but much, much earlier. So to understand Bitcoin, you have to understand that it didn't just spring forth fully formed from the mind of Satoshi Nakamoto.
Not at all. It really was built on the cumulative work of decades of cryptographers.
Yeah.
They'd been trying to solve this problem of, electronic trust and scarcity in a digital world for a long time.
So the idea was already there.
That's the key point.
Yeah.
Digital cash concepts existed long before the Bitcoin white paper. If we trace the ancestry, we see this consistent attempt to solve what's called the double spending problem.
Okay, what's that?
It's the risk that a digital currency can be spent twice. Unlike a physical coin, a digital file can be easily copied. The earliest serious concepts were these issuer-based electronic cash protocols put forward by giants in the field like David Chaum and Stefan Brands.
And what made those early attempts, not quite right for what Bitcoin was trying to do?
Well, they were foundational in terms of cryptography, but they generally relied on a central issuer.
A central authority.
Right. A central authority to mint or validate the currency. And if you wanted truly anonymous, truly decentralized electronic cash, that central issuer is a failure point.
Both for privacy and
for political resistance.
Yeah.
Those systems were prone to the very governmental oversight that later cryptographers really sought to avoid.
So the breakthrough that paved the way for Bitcoin wasn't about the central bank model at all. It was about this idea that effort could equal value.
Precisely. That idea that solutions to computational puzzles could possess inherent economic value. That is the intellectual precursor to Bitcoin's core consensus mechanism, the proof-of-work system.
And that idea came from somewhere completely different.
Completely different. The concept was first formally proposed by Cynthia Dwork and Moni Neer way back in 1992.
Yeah.
They weren't trying to design money.
No.
They were aiming to combat junk mail by making spamming computationally expensive.
That's just a fascinating application of a core concept, taking an abstract mathematical problem and applying a real-world economic cost to solving it.
Exactly.
And speaking of this long-term theoretical grounding, the sources highlight a document published years before Bitcoin even showed up.
It's a remarkable piece of history.
Good.
12 years before the network's launch, the NSA, the U.S. National Security Agency, published a white paper.
The NSA.
The NSA. It was titled How to Make a Mint, the Cryptography of Anonymous Electronic Cash, and it was dated October 31st, 1996.
Wow.
This document just demonstrates that the theoretical groundwork for anonymous cryptographic currency was very much in the public research domain of high-level government agencies for years, long before the public was ready for it.
So we have the concept of expensive computation, and we have the concept of anonymous cash floating around. Where did those two threads converge into the specific mechanism that Bitcoin uses?
They converged with the development of something called hashcash. A cryptographer named Adam Back independently developed this proof-of-work idea in 1997.
And again, this was for spam control.
Yes, it was an ingenious solution for spam. You had to expend a small amount of CPU time to generate a hash proving you'd done the work. If you were sending one email, it was negligible.
But if you were a spammer sending a million,
It becomes prohibitively costly.
the sources show that Hashcash proved that you could make it economically infeasible to perform mass malicious actions by attaching a small, verifiable computational cost to every single action. So if Back gave us the mechanism, who gave us the architectural vision for a fully distributed currency?
Ah, that brings us to the actual proposals for distributed scarcity-based systems that look much, much closer to what Bitcoin ultimately became.
And these were
We have Wayday's B-Money and, even more critically, Nick Szabo BitGold. These cryptographers are really the intellectual godfathers of the movement. They push the idea beyond just spam control and into actual asset creation.
Let's focus on Nick Szabo's BitGold for a moment. What specific architectural choices did he make that really foreshadowed Bitcoin?
Szabo was incredibly prescient. I mean, he investigated a collectible market-based mechanism for inflation control, which is the idea that new currency issuance would become increasingly difficult over time.
So like mining.
Very much like mining. But the truly Bitcoin-like element was his exploration of a Byzantine fault-tolerant agreement protocol.
Oh, okay. Can you clarify that for our listeners? What is a Byzantine fault-tolerant protocol in this context?
So the Byzantine general's problem is this classic distributed computing dilemma. How do you get multiple independent parties, the generals, to agree on a single course of action, say, whether to attack or retreat?
When some of those parties might be corrupt or unreliable, the faulty generals.
Exactly. Yeah. Szabo proposed using what he called quorum addresses to store and transfer chained proof-of-work solutions. The idea was that the network could achieve consensus, even if parts of it were dishonest.
That sounds like an almost complete system. But the sources point out a fatal flaw in the BitGold design.
The crucial vulnerability was its susceptibility to Sybil attacks.
Right.
For those who aren't familiar, a Sybil attack is where a single entity, often malicious, overwhelms a decentralized network by creating numerous fake identities, or nodes.
So one person pretending to be 1,000 people.
Precisely. If Szabo's protocol relied on a majority consensus based on these quorum addresses, a well-resourced attacker could create enough fake identities to subvert the network consensus. They could manipulate the ledger, and that would fundamentally destroy the trustless nature of the system.
So the key challenge was establishing a distributed, robust identity system. The final piece of the technical puzzle before Nakamoto arrived involved taking Adam Back's idea and making it usable for value transfer.
That's where Hal Finney comes in. Hal Finney, a key figure we will return to shortly, took the Hashcash concept and applied it to create reusable proof of work, or RPOW.
RPOW.
RPOW used Hashcash as the algorithm, but it added a crucial server that managed the tokens, ensuring that the proof of work, once created, could be spent and transferred again.
I see.
This continuous evolution from non-centralized cash protocols to proofs of work for spam, then reusable proofs of work, it just demonstrates that the crypto community was persistently trying to create a viable, decentralized mechanism for value transfer for over a decade before Bitcoin finally managed it.
So Bitcoin's true innovation was the elegant combination of all these existing ideas, proof of work, chaining blocks, and finally solving the Sybil problem through the economic incentive of mining.
That's it. It brought all the pieces together.
Now we arrive at the pivotal moment. This is when all these disparate cryptographic concepts finally coalesced into a working network. And the timeline is, well, it's almost dramatic in its precision.
It was a very deliberate rollout. August 18, 2008, the domain name bitcoin.org was registered. Okay.
And then, at the absolute height of the 2008 global financial crisis, on October 31st, 2008, a paper was posted to a key cryptography mailing list, authored by the pseudonymous Satoshi Nakamoto.
That paper? Bitcoin. A peer-to-peer electronic cash system. It didn't just propose a new currency, it proposed an entirely new architecture for trust. The abstract promised a peer-to-peer network for electronic transactions without relying on trust.
And that phrase, without relying on trust, that immediately positioned the project as a revolutionary answer to institutional failures.
The timing was perfect.
It was perfect, and the launch followed swiftly. The Bitcoin network officially came into existence on January 3, 2009, when Satoshi Nakamoto mined the Genesis block, which is designated as block number 0.
And that first block carried a reward of 50 Bitcoins. Though, as our sources note, those initial coins are generally considered unspendable due to the way the Coinbase transaction was structured.
That's right. What gives the Genesis block its truly profound historical weight, beyond just starting the ledger, is the message Nakamoto chose to embed within it. It's an explicit piece of political commentary fused right into the bedrock of the entire system.
It is perhaps the most analyzed piece of text in Bitcoin history. Embedded deep inside that initial block was the text. The Times 03 Jan 2009 Chancellor on brink of second bailout for banks.
And that phrase was taken verbatim from the headline of the UK published newspaper The Times on that exact date.
Exactly.
The sources allow for a dual interpretation of this message, and I think we need to explore that tension. On one hand, it served as an undeniable, cryptographically verified timestamp.
Absolutely. The timestamp function is crucial. By referencing a current news event, Nakamoto proved that the network was launched exactly when the creator claimed it was.
Which would preclude any claims that the blockchain was secretly pre-mined or launched earlier than the publication date of the paper.
Correct. It established chronological legitimacy.
But the more enduring interpretation, the one that really defines the entire ethos of the early community, is the political commentary.
That's where the context of the 2008 financial crisis comes into play. The message referenced the UK Chancellor and the potential for a second bank bailout,
Second one.
highlighting the systemic fragility of fractional reserve banking and centrally controlled currencies. It contextualized Bitcoin's creation not as a purely technical exercise, but as a necessary philosophical and financial counterreaction to a broken, unstable, state-run monetary system.
It framed Bitcoin as a protest, a digital lifeboat built specifically to escape the sinking ship of traditional finance.
That's a great way to put it.
Shortly after this powerful statement, we get the first documented use of the system for its intended purpose.
That was the first documented transaction occurring on January 12, 2009. It corresponds to Block 170. This was the transfer of 10 Bitcoins from Nakamoto to halving.
The same halving who developed RPOW.
The very same. This exchange is monumental. Finney was the first person known to have run the software, so he was a key early contributor and technical validator. This transaction demonstrated that the peer-to-peer electronic cash system was functionally operational.
It's amazing to think about that. It wasn't a corporate launch with a big press conference.
No.
It was a collaborative cryptographic project between a few dedicated people.
It was entirely grassroots. And this brings us to the most enduring question surrounding the project: the identity of its architect.
The pseudonym Satoshi Nakamoto. It remains a shroud over the person, or maybe group, who designed the protocol, released the paper, and launched the network.
And we know that in the early days, based on analysis of the blockchain, Nakamoto personally mined about 1 million Bitcoins. That's often referred to as the Satoshi stash.
And then just vanished.
Disappeared. The involvement in the project appears to have ceased sometime around mid-2010. Nakamoto handed over control of the critical code repository and the network alert key to developers Gavin Andresen.
Right. Andresen later became the lead developer for the protocol and one of the founders of the Bitcoin Foundation. He kind of stepped into the public representative role that Nakamoto explicitly avoided.
He did. And in April 2011, Nakamoto sent a final email to a key developer stating simply that he had moved on to other things.
The speculation about who Satoshi Nakamoto is has been relentless, fueled by all this circumstantial evidence that's detailed in the sources. The early community, they pointed fingers at the usual suspects, right? The intellectual godfathers we mentioned earlier.
Indeed. Wei Dai, Nick Szabo, Hal Finney, they were all immediately suspected, given their pioneering work in digital cash and proof of work. But all of them, publicly and repeatedly, issued denials.
There was also the theory that it wasn't one person.
A persistent, though less verifiable, theory that Nakamoto was not an individual, but a computer science collective, maybe operating within the European financial sector. It would reflect the complexity and the multifaceted nature of the original code.
The hunt for clues led major publications down some pretty deep rabbit holes, including the Fast Company investigation that tried to link the white paper to a specific patent application.
This was a very compelling piece of circumstantial evidence. Fast Company identified an encryption patent application filed by Neil King, Vladimir Oxman, and Charles Bry in August 2008.
Just 3 days before Bitcoin.org was registered.
The timing was suspect, and the technologies described were structurally similar. But more damningly, a textual analysis revealed that the specific, highly technical phrase, "got computationally impractical to reverse," appeared identically in both the patent application and the Bitcoin white paper.
That seems like an incredibly strong linguistic fingerprint. But what did the inventors say?
They all denied involvement, which either means they were committed to their anonymity or the textual link was just a coincidence of similar technical writing styles.
The ambiguity is what keeps the mystery alive.
It is. And then separately, we have had other high-profile, if quickly retracted, claims.
I remember the media frenzy around the Newsweek attempt to unmask him.
That was the most sensational attempt. March 2014, when Newsweek doxed Dorian S. Nakamoto, a man in Temple City, California, claiming that was his birth name.
It caused a huge stir.
It drew immediate widespread criticism and media stakeouts at the man's home. The public pressure forced Dorian Nakamoto to hold a press conference denying any involvement. That whole incident just highlighted the danger and the intensity of the public's desire to put a face to the name.
So if the identity remains disputed and the denials are firm, what behavioral or linguistic clues drawn from the sources do investigators rely on most heavily today?
Well, the primary behavioral clue comes from timestamp analysis. A Swiss coder named Stefan Thomas meticulously graphed the timestamps for Nakamoto's more than 500 forum posts and emails.
And what did that graph show?
The resulting chart showed a distinct dip to almost no activity between the hours of 5 a.m. and 11 a.m., Greenwich Mean Time, GMT.
And that pattern held consistently, even on weekends.
Suggesting Nakamoto was asleep during this period.
And if you convert that window, that corresponds almost perfectly to midnight to 6 a.m. Eastern Standard Time in North America.
Which points strongly towards someone operating on U.S. East Coast time, or maybe Central or South America, but probably not Europe or Asia.
But this is complicated by the linguistic evidence, which points the other way.
The British-English connection. Correct. The sources suggest Nakamoto was potentially British, or at least heavily influenced by British English.
Not just the headline from the Times.
Not just the headline. His forum posts and comments within the source code consistently use British English spellings, like optimize, color, and bloody hard.
So this synthesis, someone operating on North American hours but using British English spelling, that continues to fuel the debate.
It leads some to theorize a collective authorship, or just a very complex effort to obscure identity.
And finally, there's that long-standing theory that tries to link the writing style directly to Nick Szabo, where a textual analysis found similar phrasing between the white paper and Szabo's BitGold articles.
But again, he denies it. So whether it was him, a group, or someone else entirely, the mystery served a vital function. It protected the project in its nascent stage from the regulatory and political scrutiny it would soon attract.
For the first year or so, Bitcoin was fundamentally a cryptographic curiosity. It was used by tech hobbyists to send coins to each other with minimal real-world value.
Right.
It took time for the idea of electronic cash to actually translate into real-world commerce. And that shift is perfectly encapsulated by the famous anecdote we celebrate every year, Bitcoin Pizza Day.
May 22, 2010. This is cited in the historical documents as the very first notable retail transaction involving physical goods.
It's a great story.
A Florida-based programmer named Laszlo Hanyecz offered 10,000 Mine BTC on an online forum to anyone who would order and deliver him 2 pizzas from Papa John's in Jacksonville.
And someone took him up on it.
A user in England, Jeremy Sturdivant, accepted the challenge. He used his own credit card to complete the purchase.
At the time, 10,000 Bitcoins were valued at roughly $40 USD. I mean, the current value is often used to illustrate the incredible return, but the real significance is symbolic.
It was the moment the theoretical, intangible coin touched the physical world. It moved Bitcoin from a pure cryptographic experiment to a functional medium of exchange, however minimal the value was at the time.
It was a proof of concept.
A critical proof of concept. It showed that this digital asset could be liquidated into a physical good through the cooperative effort of the network.
This single transaction marked a major inflection point, signaling the potential for real commerce. But as the network grew, it immediately ran into a nearly catastrophic technical challenge that threatened its entire monetary policy.
It really did.
Let's talk about the only major security flaw ever found and exploited in Bitcoin's history, which occurred in August 2010.
This was an existential threat. The vulnerability stemmed from an integer overflow bug in the protocol's verification system.
Okay, what does that mean in simple terms?
Essentially, the Bitcoin protocol was designed to confirm that the sum of transactions' outputs never exceeded the sum of its inputs. This prevents the creation of new, unauthorized coins.
Right, no printing money out of thin air.
But if a transaction's outputs were massive, specifically, if they summed to more than the maximum number that could be stored in a standard 64-bit integer, the sum would overflow or wrap around, tricking the system into thinking the outputs were actually smaller than the inputs.
And someone found and exploited this loophole.
On August 15, 2010, the vulnerability was exploited. A single transaction was broadcast that spent just 0.5 Bitcoin. but managed to issue just over 92 billion new Bitcoins to two different network addresses.
92 billion. Given the protocol mandates a total supply cap of only 21 million Bitcoins, this was an instant inflation event that should have destroyed all confidence in the scarcity and security of the network.
It should have. The whole premise relies on a fixed, predictable supply.
So how did they fix it?
The response from the core developers, including Gavin Andresen, was a model of swift, decentralized crisis management. The vulnerability was spotted within hours.
That's fast.
The bug was patched immediately, and the core developers urged miners to update their software. The entire blockchain was immediately forked by the majority of the network, using the patched version of the protocol.
So what does forked below the problematic transaction mean for the listener?
It means that the corrected version of the ledger, the one adopted by consensus, ignored the block containing the 92 billion Bitcoin transaction entirely. It essentially began a new, legitimate chain from a block immediately preceding the fraudulent one.
So the 92 billion Bitcoins never really existed in the history that the network ultimately accepted.
Exactly. This decentralized, voluntary correction, achieved without a central authority, solidified confidence that the community could respond rapidly and effectively to systemic threats. It arguably saved the entire project.
As the technology matured and stabilized, supporting infrastructure began to emerge, showing that people saw a viable commercial future in this new ecosystem. The focus shifted from cryptography to business integration.
The first step was making it easy for merchants to accept it. In May 2011, BitPay was founded specifically to provide mobile checkout services.
They acted as a payment processor.
Right. They allowed businesses to accept Bitcoin seamlessly and then immediately convert them to fiat currency, insulating the merchant from volatility. This significantly lowered the barrier to entry for retailers.
And it worked.
They reported having over 1,000 merchants accepting Bitcoin under their service by October 2012.
Alongside the commercialization, we saw major nonprofit organizations testing the waters of adoption, which added a layer of legitimacy and philosophical backing.
The Electronic Frontier Foundation, the EFF, was one of the first. They started to accept Bitcoin donations in January 2011.
But they got nervous.
This period was fraught with legal uncertainty. They paused acceptance in June 2011, citing concerns about a lack of clear legal precedent regarding new currency systems.
But they came back.
They later reversed that cautious decision in May 2013 and resumed acceptance. At the same time, in June 2011, WikiLeaks started accepting Bitcoin donations, seeing it as a way to circumvent traditional financial blockades.
By 2012, we were starting to see a degree of formal institutionalization of the protocol itself.
The launch of the Bitcoin Foundation in September 2012 was a critical moment. Its explicit goal was to accelerate the global growth of Bitcoin through standardization, protection, and promotion of the open-source protocol.
And its founders included early figures like Andresen and Charlie Shrem. This marked a shift from a pure volunteer movement to an entity attempting to provide official guidance and stability.
It did.
And on the cultural side, the narrative was starting to seep into popular culture.
In January 2012, the CBS legal drama The Good Wife featured Bitcoin as the main subject in a fictionalized trial, bringing the concept into millions of homes. The sources note that even Jim Cramer, the financial personality, played himself.
What did he say?
He testified that he didn't consider it a true currency because there was no central bank to regulate it. This established the public perception early on. Bitcoin was a serious but unregulated concept.
And the culmination of this early acceptance came in late 2012 when a major content platform integrated it.
WordPress started accepting Bitcoins in November 2012. This was significant because it meant a major platform, a widely used tool for creating online content and commerce, was willing to integrate the asset, moving it firmly into legitimate online transactions and signaling that volatility wasn't stopping commercial use.
By 2013, Bitcoin was past the haughty stage, but it was anything but mature. This period is defined by massive market volatility, internal technical crises, and that unavoidable clash between decentralization and global government regulation.
The market swings were breathtaking and unpredictable. Early in 2013, Coinbase reported selling $1 million worth of Bitcoins in a single month at over $22 per coin.
And then the crash.
Just months later, in April, due to processing delays experienced by major exchanges like Mt. Gox and BitInstant, a sign of the network being overwhelmed, the price per Bitcoin plummeted from $266 down to $76 in a single day.
But it recovered quickly.
It recovered to $160 within 6 hours, but those rapid movements cemented its reputation as a wildly speculative asset.
That kind of wild ride tested the nerves of early adopters. That same year, there was a major internal technical crisis that highlighted the fragility of network consensus under rapid technological development.
This was the infamous March 2013 blockchain split. The conflict arose because a minority of miners were still running older software, version 0.7.
And that used a different database architecture than the newer version.
Well, exactly. So when a miner running 0.8.0 created a particularly large block that was deemed valid by the new rules, the older 0.7 nodes rejected it as invalid because of their internal database limits.
So essentially, the network split its brain. They had two different versions of history running simultaneously. What was the risk of this happening?
The risk was catastrophic.
Yeah.
If the split had persisted, users who spent coins on the 0.8 chain might find those coins still existing on the 0.7 chain.
Double spending.
A permanent fracture of the ledger. The price immediately reacted to this threat. Mt. Gox halted deposits, and the price dipped 23% to $37.
How is this crisis averted?
The core developers intervened immediately, calling for an emergency consensus decision. The resolution involved urging the majority of the network to temporarily downgrade their software back to the more compatible version 0.7.
So they rolled back to the older version to get everyone on the same page.
It forced the network to realign with the canonical, or correct, blockchain, resolving the split within hours. The crisis demonstrated that while the network was decentralized, it still required human intervention and voluntary consensus to resolve fundamental incompatibilities.
As prices surged later that year, spiking from $200 to $900 in November 2013, governments could no longer afford to treat Bitcoin as a curiosity. This period marks the start of regulatory definition, beginning with the U.S. Treasury's Financial Crimes Enforcement Network.
Yes, FinCEN. In March 2013, they issued landmark guidance defining Bitcoin as a virtual currency. And critically, they explicitly stated it was not legal tender under U.S. sovereign jurisdiction.
A very important distinction for legal and tax purposes.
Immensely important. But the truly strategic ruling was their definition of who qualified as a money service business, or MSB. This ruling changed the compliance landscape overnight.
It did. What was the key distinction?
FinCEN clarified that an ordinary user of virtual currency is not an MSB, so they aren't subject to the crushing burden of registration and money laundering regulations.
But the exchanges were.
Any American entities that generate or exchange virtual currency, specifically miners who sell their generated currency for national currency, or exchanges that facilitate fiat to crypto swaps, are classified as money transmitters. They became subject to stringent MSB registration, reporting, and anti-money laundering regulations.
This is the strategic insight. By regulating the exchanges and the miners, the U.S. government intentionally created regulatory choke points in a system designed to avoid central control.
Exactly.
You couldn't stop the code, but you could regulate the on-ramps and off-ramps to the traditional economy.
That analysis aligns precisely with the FBI's earlier internal assessment from April 2012. It acknowledged Bitcoin's decentralized and pseudonymous design as a challenge for law enforcement, but highlighted that third-party exchanges were the vulnerable regulatory points susceptible to U.S. law. They knew where to apply pressure to enforce control.
That framework was quickly tested globally, leading to mixed and sometimes conflicting legal interpretations.
In August 2013, a U.S. federal judge in Texas ruled that Bitcoins are a currency or a form of money, specifically defining them as securities under federal securities laws, which brought them explicitly under court jurisdiction.
And in Germany.
Simultaneously, Germany's finance ministry characterized Bitcoin as a unit of account, a financial instrument, though not e-money carrying its own set of distinct legal and tax implications. This period showed global governments just trying to shove around decentralized peg into square centralized regulatory holes.
But the most disruptive regulatory action, the one that immediately caused market panic, came from China.
In December 2013, the People's Bank of China prohibited financial institutions from using Bitcoins. They were acutely concerned about money laundering risks and capital flight.
But individuals could still trade it.
They permitted individuals to trade it as a commodity, but they strictly forbade financial banks from operating using it as currency. This announcement caused the value of Bitcoin to drop between 11% and 20% on various exchanges before eventually rebounding, signaling China's overwhelming influence on the market.
Alongside this regulatory push, law enforcement became heavily involved due to Bitcoin's highly publicized association with illicit online marketplaces.
The connection between Bitcoin and the dark web was cemented by the existence of Silk Road, an infamous online drug and illegal goods marketplace.
Right.
The first official interaction with U.S. law enforcement occurred in June 2013 when the U.S. Drug Enforcement Administration seized 11.02 bitcoins. This was rapidly followed in October 2013 by the FBI's high-profile seizure of roughly 26,000 BTC from the Silk Road website during the arrest of alleged owner Ross William Ulbricht.
And this demonstrated that while the asset was pseudonymous, the transactions and the wallets were traceable when linked to criminal activity.
It showed the limits of that pseudonymity.
The narrative of crime, theft, and collapse peaked dramatically with the failure of Mt. Gox, which was just a devastating blow to the fledgling ecosystem.
Mt. Gox was the central pillar of the early market. It handled a staggering 70% of worldwide Bitcoin traffic in 2013. Its collapse in 2014 was a crisis of confidence.
They suspended withdrawals in early February 2014, ostensibly citing technical issues.
But by the end of the month, the Tokyo-based exchange filed for bankruptcy protection. The core issue, which would take years to untangle, was that 744,000 Bitcoins were missing, valued at about $390 million at the time.
An incredible sum. And this massive failure highlighted the extreme risk of centralized, unregulated custody, the very system Bitcoin was meant to bypass.
It was the ultimate irony. And the failure was systemic, impacting other early exchanges.
It was a brutal reality check on custodial risk. Flexcoin closed its doors shortly thereafter in March 2014 following a hack.
And then Cryptsy, a U.S.-based exchange, failed in January 2016. While ostensibly due to an earlier hacking incident, a subsequent investigation by a court-appointed receiver alleged that the CEO had stolen $3.3 million.
This whole chaotic period just demonstrated that the technology was sound, but the human-operated infrastructure built around it was often fragile, insecure, or fraudulent.
Absolutely. The protocol worked. The companies built on top of it often didn't.
Despite the exchange failures and the regulatory uncertainty of the Mt. Gox era, a steady stream of corporate adoption began in 2014. This signals a long-term belief in the underlying technology and marks the beginning of the pivot toward mainstream financial acceptance.
2014 was the year that Bitcoin entered the high street, digitally speaking. Companies started testing it for purchasing digital goods like Zynga for in-game assets in 7 of their games.
And it moved into the physical world, too.
It did. Physical establishments jumped in. The D Las Vegas Casino Hotel and Golden Gate Hotel and Casino started accepting Bitcoin at their front desks and in some restaurants. This wasn't just online. It was entering physical consumer spaces.
And major online retailers followed suit, offering their enormous consumer bases the option to pay with BTC.
Absolutely. Tiger Direct and Overstock.com led the charge early that year. By July, major electronics retailer Newegg and computer giant Dell joined the trend.
And then Microsoft.
By December 2014, Microsoft started accepting Bitcoin for purchases of Xbox games and Windows software. This proliferation across entertainment, physical retail, and software demonstrated rapid, widening acceptance beyond the core tech enthusiast community.
Beyond retail, there was a crucial step into the institutional financial world. This is what moved Bitcoin from an internet currency to a financial asset class recognized by regulators.
This happened in September 2014 when the U.S. Commodity Futures Trading Commission, the CFTC, approved Terra Exchange, LLC, to list an over-the-counter swap product based on the price of a Bitcoin.
That was a critical first. A U.S. regulatory agency approved a Bitcoin financial product.
It was. It recognized Bitcoin as a commodity whose price could be legitimately wagered upon. It moved it further away from a currency and closer to something like gold or oil in regulatory terms.
The mid-2010s also brought cultural and academic recognition. The asset was just becoming too big to ignore.
You had Coinbase setting a funding record in January 2015, raising $75 million in a Series C round. That showed serious commitment from venture capital.
Culturally, there were milestones, too.
In 2015, Vienna's Museum of Applied Arts, MAK, became the first museum to acquire art using Bitcoin, which demonstrated its cultural currency. And then symbolically, in June 2017, the Unicode symbol, the capital letter B with 2 vertical strikes, was finally encoded. It got the same digital recognition as the dollar or the euro.
The rapid growth and adoption, however, highlighted a major technical and philosophical flaw in the network's original design. This led to the scaling wars and a major divergence in 2017.
This was the ultimate consequence of success, the 1 MB block size limit. Nakamoto had implemented this limit to prevent spam and preserve decentralization in the early days.
But it couldn't handle the new volume.
By 2017, the limit meant the network could only process about 3 to 7 transactions per second. As demand skyrocketed, fees became exorbitant, and transaction time stretched into hours or even days. The community split on how to solve this scalability problem.
And this disagreement led to the major hard fork of August 2017.
It was a schism based on a core philosophical dispute. One side, which remained Bitcoin, BTC, argued that the 1-to-me limit must be preserved to prioritize security and decentralization.
Confirming the transition to a store of value, something you hold, not something you spend on coffee.
Exactly. The other side, which launched Bitcoin Cash, BCH, argued for an expanded 8-MB block size limit, adhering to Nakamoto's original vision of Bitcoin as a cheap, fast, peer-to-peer electronic cash system.
And the fork resulted in 2 derivative digital currencies and a permanent ideological split within the community.
A permanent split.
Meanwhile, global regulatory recognition continued to advance even as these internal disagreements flared up.
In 2016, the Cabinet of Japan formally recognized virtual currencies like Bitcoin as having a function similar to real money. That was a significant step in a major global economy. Then, in 2017, Russia announced plans to legalize the use of cryptocurrencies. These governmental moves added immense legitimacy.
But the very technical issues that led to the 2017 fork high fees and slow transactions caused some of those major corporate adopters to retreat.
Steam is a prime example. They discontinued acceptance in December 2017, explicitly citing slow transaction speeds and high fees as unusable for their mass-market gaming platform.
Then Stripe followed.
A month later, in January 2018, Stripe, the online payment firm, announced they would phase out Bitcoin payments, citing declining demand, rising fees, and longer transaction times. This confirmed the BTC chain's difficult pivot. It's failing as a transactional currency, but succeeding as a speculative or reserve asset.
The pivot reached its peak in 2021 with the Tesla effect, which dramatically influenced both the market and the public conversation around Bitcoin's energy consumption.
It began with Elon Musk placing the word Bitcoin in his Twitter profile, which caused the price to jump $5,000 in an hour. Then, in February 2021, Tesla made the massive announcement of a $1.5 billion Bitcoin purchase and plans to start accepting it as payment for vehicles.
And that propelled the price to an unprecedented $44,141.
It did. But the acceptance was remarkably short-lived. It only lasted 49 days before Tesla reversed course in May 2021.
And the stated reason was significant.
It was about concerns that the energy-intensive mining process contributed heavily to the consumption of fossil fuels and exacerbated climate change. This public reversal by one of the world's most high-profile sustainability leaders caused an immediate market shock, dropping the price around 12% the following day.
And this event cemented the energy consumption debate as a central topic in global regulatory and social discussions.
It really did.
Musk did leave a specific door open for resuming acceptance, tying it directly to green energy metrics.
During a July conference, Musk suggested that if Bitcoin mining demonstrably reaches and consistently trends above 50% renewable energy usage, Tesla would consider resuming acceptance. The source material shows that this public mandate forced the industry to reckon with its carbon footprint in a way no government regulation had done up to that point.
Perhaps the most significant validation of Bitcoin as a sovereign financial instrument came not from a corporation, but from a nation-state.
In June 2021, El Salvador, under President Nayib Bukele, announced plans to adopt Bitcoin as legal tender. Days later, pro-government deputies passed the Ley Bitcoin, the Bitcoin lawmaking, in legal tender alongside the U.S. dollar.
So businesses had to accept it for goods and services, and citizens could use it to pay taxes. This move redefined Bitcoin's status entirely, moving it from a decentralized asset class to a recognized state-backed national currency.
A huge moment.
And fast forward to the immediate present, 2024. The final milestone involves the ultimate integration into the mainstream financial architecture, the regulated investment world.
The highlight of 2024 was the approval of Bitcoin holding exchange-traded funds, or ETFs, by U.S. regulators. This institutional product provides a completely regulated, easy path for traditional, institutional, and retail investors to gain exposure to Bitcoin without ever having to worry about self-custody or the technical complexities of wallets.
So it made it easy for anyone to invest.
The sources note that this development helped increase investment properties and diversify stocks, truly legitimizing the asset. By December 4, 2024, the Bitcoin price reached $103,332.30. and it accounted for 55.2% of the total value of the cryptocurrency market, confirming its dominance.
Despite reaching 6 figures and achieving nation-state acceptance, the history of Bitcoin is consistently marred by persistent issues: financial security and its association with criminal exploitation. It is a history littered with the wreckage of failed exchanges and theft.
When you look at the track record of centralized cryptocurrency exchanges, it's startling. A Wired study published back in April 2013 showed that 45% of Bitcoin exchanges eventually closed.
45%.
That speaks to a massive systemic risk inherent in trusting third parties in a system designed to eliminate that trust.
Let's detail some of those high-value losses because they illustrate the evolution of theft, moving from individual losses to catastrophic institutional failure.
In the early days, you saw individual platform losses, like Bitomat in July 2011, where an operator lost access to his wallet, losing about 17,000 Bitcoins. Then came the era of exchange hacks.
Bitfinex.
In August 2016, Bitfinex was breached, and nearly 120,000 BTC, valued at around $72 million at the time, were stolen from customer funds. Later, in December 2017, NiceHash, a platform for selling mining power, was hit. They lost 4,700 Bitcoins, valued at about $80 million.
And even as recently as 2022, the collapse of the FTX exchange, that sent shockwaves.
It led to an immediate hit to Bitcoin's price, sinking it to a two-year low, with an estimated $8 billion in customer funds reported missing.
These centralized exchanges, which essentially function as the traditional banks of the crypto world, have consistently proven to be the most vulnerable points for thieves and failure. The irony is unavoidable.
They represent the single point of control that the original Bitcoin design sought to circumvent. And law enforcement has spent the last decade trying to reconcile Bitcoin's pseudonymous, decentralized design with the need to prevent illicit finance.
We mentioned the FBI's early 2012 assessment that identified the challenge posed by its decentralized nature. But the U.S. Justice Department has shown that recovering illicit funds is absolutely possible, challenging that notion of complete anonymity.
The most high-profile example of this recovery capability came in June 2021. The Justice Department recovered $2.3 million worth of Bitcoin paid by Colonial Pipeline to a criminal cyber group as a ransom.
So it can be traced.
It proved that tracing and seizing assets on the blockchain, even if the wallets are pseudonymous, is not computationally impractical for state actors armed with sophisticated forensic tools. The perceived anonymity of Bitcoin is conditional.
Beyond outright theft, regulators have also focused on stopping price manipulation within this volatile asset class, treating it now like any other security market.
In May 2018, the U.S. Department of Justice launched an investigation into Bitcoin traders for possible price manipulation. The focus was on illicit trading practices like spoofing.
Placing large orders without the intention of executing them to trick others into buying.
Right, and wash trades, buying and selling the same asset simultaneously to artificially inflate trading volumes.
And this investigation showed the government's willingness to treat crypto exchanges with the same heavy hand they use for traditional securities markets.
Key exchanges like Bitstamp, Coinbase, and Kraken were subpoenaed by the Commodity Futures Trading Commission, the CFTC, after they initially failed to comply with information requests regarding trading data. It demonstrated the seriousness of the government's commitment. If Bitcoin is going to be traded as a financial commodity, it must adhere to the rules designed to ensure market fairness.
This inherent tension between Bitcoin's transparent but often pseudonymous ledger and traditional legal structures leads us to perhaps the most severe and problematic legal challenge documented in the sources: the arbitrary content dilemma.
This is a truly unique legal threat, entirely due to the fundamental characteristic of immutability. Because the blockchain can be loaded not just with transaction data, but with arbitrary data messages, links, or files. Research from 2018 documented that 1,600 files had been permanently added to the public ledger.
What was the implication of the content found by the researchers?
The severity cannot be overstated. The researchers found that 59 of those files included links to highly unlawful content, specifically images of child exploitation, alongside politically sensitive material and major privacy violations.
And their conclusion was blunt.
It was.
Yeah.
Our analysis shows that certain content, e.g. illegal pornography, can render the mere possession of a blockchain illegal.
That is a staggering legal implication. Can you explain why the possession of the blockchain could be considered illegal?
Because the full Bitcoin blockchain is downloaded and distributed by network nodes globally to validate transactions. If illegal content is permanently recorded in an immutable block, that content is copied and stored on every single computer operating a full node worldwide.
So every node operator is holding it.
Under various international laws, the mere possession of such material, regardless of intent, is a criminal act. Since there is currently no mechanism to unilaterally wipe data from the immutable chain, every full node operator is technically hosting this material, creating a massive, unsolvable international legal liability.
And this threat is not limited to text or images.
That's right. In 2015, Interpol sent out an alert raising concerns about the possibility of malware being injected and permanently hosted on the blockchain. Because the data cannot be deleted, a malicious actor could theoretically use the blockchain as an indestructible host for malware.
It's a double-edged sword.
It highlights the severe double-edged sword of permanence. While it ensures transaction integrity, it also ensures the eternal life of malicious or illegal data uploads with no current method available for removal.
If you look at this history, the trajectory of Bitcoin is truly incredible. It spans from those early precursors like David Chaum's eCash and Nick Szabo's BitGold, through the Genesis block and the chaos of Mt. Gox, to its current status as a globally recognized asset class and even legal tender in El Salvador.
It's an amazing journey.
It has successfully navigated technological failures, criminal exploitation, and political resistance to become a dominant force in finance.
What stands out here is the profound philosophical conflict inherent in the entire narrative we have reviewed. This is a technology founded on anonymity, cryptographic control, and decentralization. A direct, explicit commentary against failed central banks and unstable fractional reserve systems.
Right.
But how does this technology reconcile itself with the inevitable pressures of state regulation, like the choke points created by FinCEN and the outright bans imposed by the People's Bank of China?
And with the final total institutional financial acceptance embodied by the 2024 ETF approvals.
Exactly. That tension between the anarchist, trustless ideal and the massive regulated financial reality is what will fundamentally define its next 15 years.
That's certainly something to think about, especially as regulatory bodies worldwide continue to grapple with how to manage an asset that just refuses to conform. Thanks for listening.